Hello and welcome to this week's episode of Spy Trader Now. Today's date is December 17th, 2022, and our portfolio is up a little bit better than 21% year to date. We made no trades this week, but the S&P 500 dropped this week to a total of a little over 19% for the S&P 500 buy and hold strategy for year-to-date results. That's down about 19%. We're up 21%. That is a difference of about 40% difference. You can see that difference here. We are completely smoking the S&P 500. You are doing better than the buy and hold investor by 40% with this strategy. That is the power that this strategy can bring to you. So with the way that I do my trading, it's a 3-stock or 3-position portfolio. It's either going to be in SPY stock, which is the shares of the S&P 500 traded as the ETF, or in SPY options, calls or puts, depending upon market direction, or we're in cash. Right now, we are in cash. You can see that right here. We are 100% in cash with a little bit more. We start our portfolio, the starting capital is $100,000. So we're up 21%, hence 21%. And this has been a very tough year for trading because the S&P 500 is down just over 19%. So that is the power that I'm trying to give to you with this strategy. That is why we do buy, sell, and trade the S&P 500. We're trying to put more of this green in your pocket. Now, the S&P 500 dropped 2% this week. So even though we didn't make any trades, because the S&P 500, which this candle on the far right is the last week's action of the S&P 500, you can see it here blown up in the thumbnail. So it started the week here, tried to rally, and then shot back down. But it's off the bottom by a little bit for the week. SpyTraderNow.com is my website where you can sign up to get my real-time trade alerts. You can also go there to see my full trade list like this. This is just a snippet, but you can see my full trade list over the past 3 years for free, and that is where you can also sign up for my trades. Now, my YouTube site handle, which is SpyTraderNow, which you're watching this video, that is my handle. Please go ahead and hit that subscribe button, hit that bell to be notified, and do me a solid if you enjoy this content that I'm presenting to you and I'm trying to promote for other people. Hit that like button for me. Thank you very much. Now here is the portfolio. Now this is not accurate because we didn't flatline all the way up until November and then come up. I just wasn't tracking the data until right about here. So this information is accurate, but this is not. And I reset this back to $100,000 come January, and we're just 2 weeks away from that. So starting next year, you're going to see the portfolio starting from $100,000. Buy and hold. This is accurate information. This is how, if you were a buy and hold investor, how your portfolio would have fared over the past year to date. So this is how we did there. And here is the portfolios combined. So the pink is the SPY with the buy and hold. This is in a percentage basis. So starting in January 1, if you started off at 0%, you can see that SPY is down right now. It's actually about 19%, so we all know that. And whereas my portfolio is up here at about 21%. So that is the difference between the two, looking at it as a comparison basis. This is the way I think all traders should compare their results. They should show it up against the S&P 500, which is an industry standard index, to determine how well your strategy fares against just doing the buy and hold. If you cannot beat a buy and hold strategy, there is no reason to try other strategies. You can try them, but if it's not a proven success, there's no reason to stick with them. Okay. Now, what happened last week? What happened was the Fed. The Fed made a change and they increased the interest rate levels 50 basis points, bringing the level now up to 4.25 to 4.5%. Now it says here December 15th, but it was actually down on the 14th. And I'll show you that on the next slide. I think it's the next slide. Okay, so there's Jerome Powell. He's the guy that made the change. He is the chair of the Fed Chair Jerome Powell. Okay, so on Wednesday, December 14th at 11 a.m. Eastern Standard Time, that's when the Fed announced their rate decision to raise the market by 50 basis points. This arrow right here is that trading day. So at 11 o'clock on that day is when the market announced. And the market did not really move too much. I mean, it's down for the day, but the news came out at 11, and you can see that we didn't close at the highs, we didn't close at the lows. We closed somewhere around the middle of the day. It was the next day that the market just fell off of a cliff and went down. Now, my last trading day, which I had a small portfolio of 25% in SPY shares, was right here, and I decided to exit because the market had came down. These are my support and resistance lines, and we met the support, bounced, and it looked like it wasn't going to hold and come down, and I was afraid it was going to break the 30-day and then come down, and I was skittish on the market anyways. I should have held on because I would have captured, at least on that 25% position, I would have captured some gains if I'd have waited till this resistance line and then sold out. But I'm not so much of a day trader, I'm more of a trend trader. So I'm looking to get the overall trend correctly as opposed to the intraday moves, but that would have been a nice capture had I captured that. But I did miss out on this. Now, from when the Fed announced to where we are at right now, that's a 3.56% drop. Now, one of the other things that I track to help my opinion of the market is the yield curve. This is for bonds. So we look at treasury rates and we compare short-term yields, which are 91 and 2-year yields, up against longer-term 10-year yields. The 10-year yield should be a higher return than the short-term yield, especially the 91-day. Right now, the 10-year yield as of 12/17/22 is 3.51, which is lower than the 91-day and the 2-year. All this information is at bankrate.com. You can go to this website right here in order to get that. I'll see if I can leave this link in the description down below. But basically, what's happening is that the bond market is telling you that they do not like the way where things are headed. An inverted yield curve is also a precursor to a recession. Now, everyone has been talking, and it is well forecasted, that in 2023, we're going to have a recession. The yield curve inversion, which you're observing right now in this market, is also telling you that to expect a recession. Two negative quarterlies of gross domestic product is technically a recession for the United States, and we are expected to hit that in 2023. So this is all telling you that. This is also one of the reasons why I'm skittish on the market. First of all, compared to 1 year ago, you have rising interest rates. So if you look at where the 10-year yield was 1 year ago was at 1.44%. Now it's at 3.51. That's a rising interest rate. Also, you have a yield curve inversion. Both of these things are telling you just get out of the market in general, just out altogether. Now, I'm more of a trader, so I'm looking for a bounce for it to come up and get back in and go long and then go short again. But this information is telling you to stay out of the market or be short the market. Now, let's look at the VIX. The VIX currently is at 22.62. So we are right here on the VIX. The VIX is telling you that we should be more sellers than we should be buyers right now. But it did pop up and it may drift back down. I'm kind of thinking that it's going to drift back down over the next week or two, which means that being short the market is not going to be where you want to be. And I'll show you that during this presentation. Okay, here is a weekly chart of the S&P 500 SPY ETF. This is the 1 week's candle where we traded right now. And I had this line here as support. This line here is resistance. And we're in a megaphone pattern right now. And we broke this 390 support line. We are now trading below it. And we tagged that upper resistance line. Boy, I sure wish I had gone short right at that moment, but I did not. So I missed out on that. But here's where we sit right now. And we came down with a little bit above average volume for the week. So the market appears now that it's going to, over the next 10 weeks or so, just like it did last time, it's going to stair step and just drift down and come down towards this lower level. Now it could drop all the way down to this level here, which means that from its current level, it could drop another 17% before we hit support lines here and here. There's a potential for it to come down that low. I don't think it's going to, but anything is possible with the stock market. That would be an overall drop of 33% on the S&P 500. I don't think that's going to happen. I think that once it reaches that double bottom, it may find some support, or it may drift a little bit lower right here at this lower trend line, find some support at the 330 level, and then come up from there. But we're a long ways away from that happening. So we have to trade what's in front of us today, and this is where we're at today. And this is on a daily chart, and this shows you where I made my exit. I sold and went to all cash on 12.9, which is that red candle right there where my cursor is at. I missed out on that, but I missed out on losing from here to here. So that's why my portfolio is up a couple of percent over the S&P 500. Now the MACD is telling you that we're in a negative condition, but the slow stochastic is at the 20 level, which is generally speaking can be considered an oversold level. So this market could absolutely bounce. So on a short-term basis, we can bounce from here. That's why I'm hesitant to go long or go short. Here, don't forget that when we look at our seasonality of the S&P 500, going back 20 years, December has a 70% probability that it's going to close higher than it opened for the month of December. This is a monthly chart of the S&P 500. Each one of these candles represents 1 month's trading action. We are currently right here at the lower end of this candle. For this 70% probability to be true, this candle, which is currently down on a month-to-month basis of 5.56%, would have to raise to a level greater than 5.56% from where it's at now by now to the end of the month, which is about 2 weeks of trading. So seasonality-wise, the odds are against us that we're going to go down more than where we're at right now. There's a higher probability, seasonality basis, that we're going to actually go up over the next 2 trading weeks. Another reason why I'm skittish to go short right now at this juncture. Now this is on the Think or Swim TD Ameritrade platform. This is a 1-year chart, and right now what we're looking at here on the pink lines, that is your standard deviation of -1 and +1, and the gold lines is your standard deviation of -2 and +2. Well, we went just above the +1 standard deviation, similar to what we did over here, and here we didn't even reach it, and here we didn't even reach it. But we went a little bit beyond it, and we came now down, and now we are below. Oh, I'm sorry, this is last week's trading action. This is where we're at this week. You can see that we came up, hit this +1 standard deviation twice, went up above it, and now we're clearly down below it. And we're almost at the midpoint, which is the middle of the channel. So the market does try to reach the reversion to the mean, they call it. So once it reaches the mean, that would be like at equilibrium for this chart over a 1-year time basis. The MACD, which is looking, I'm sorry, this is slow stochastics. This is MACD, so the MACD, of course, is coming down, and the histogram is telling you it's coming down, and the slow stochastics is right here, and it's already at the kind of like an oversold level, or at the -20, I believe that is. Okay, now this is a shorter term basis. On a 3-month chart, the same thing, Thinkorswim platform, S&P 500, 1-day daily chart, but only going back 3 months. You can see that we are below the -1 one standard deviation. We're going towards the -2. Are we going to reach the -2? We didn't even reach the -2 on this blow-off day. The probabilities of us meeting or reaching the -2 right now are not great. So the market is going to have a bounce over the next week. Where exactly is it going to bounce? I don't know. But my expectation is it's going to bounce, and it's going to bounce and come up for about 1 week. Kind of like come down, come up, kind of like this. Where here it's down 3 days, up 4 days. Here it's down 4 days. So the market, it's unpredictable, but from statistics, I'm thinking that over the shorter term basis, we are in an oversold condition, and we are going to bounce. We're going to come back up. And once we come back up, soften and begin to turn, that is when I want to short this market. I'm probably not going to take advantage of going long. If I do go long, it's not going to be with options. It would just be with SPY stock. So it's possible that I might want to do that. I have to see how the market reacts. If it comes down here to the -2 and I start to see some bottoming action, I think I'm going to go long at that point in time. But I have to see how the market reacts before I make that decision. I want to see where the candles lie on the chart before I make a decision about my trades. But basically, that wraps up last week. I hope that you made some money last week. Please join my team here with us. We're at spytradernow.com. You can sign up to get my real-time trade alerts. Don't forget to hit that subscribe, hit that bell to be notified, and do me a solid and hit that like button right now. I wish you good trading.